Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. Sorry, it's been a bit. I'm your co-host, Tom Schneider with NinjaTrader. It is Thursday, March 30th, and before we get into the good stuff, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. It doesn't keep you up at night. It doesn't extend your retirement horizon. Also want to remind everybody that past performance is not indicative of future results. And what we talk about here today on this show contains neither trade recommendations nor financial advice, but should be used for educational purposes only. And with that out of the way, it's my pleasure to welcome back Anthony Crudele. Anthony, how are you doing?
Good, Tom. How are you? I got the NinjaTrader DYE red V-neck on today, man. Let's go.
I I love it. I think that's the exact same code, right? The same six-digit code that we use on our website. It looks like it anyway from where I'm sitting. I love it.
That's how devoted I am. I'm printing t-shirts in the color scheme. This is big.
Oh, it looks great. You look great. Excited for this week's topic, identifying trend days. When I saw that, I was like, wow, this is something that we always think about subconsciously. I think we don't think about it consciously. We want to respond to the market, but really, this is how traders can potentially make money, is identifying trends.
I got to tell you, it's one of those things where you don't really think about it as a trader when you're building your strategy. You're just looking for level to level. You're looking for good entries, right? And then you're working on, exits. And then how could I better my exits? And you're just always so focused on really that good entry to start that you get really almost hyper focused on that short-term chart, finding that spot and going, man, this is a good place where I would want to enter the market. And traders just really get so caught up in that in the short term and say, why would I need to worry about how the day is going to be, if it's going to be a choppy day or a trend day, because they're just only worried about that entry. And they're saying, I just want to take a little piece out of the market. You hear a lot of people say, I just want to make a couple points a day, or I'm just looking for that one trade per day. And what you eventually get to the point of is something I've tweeted about quite a bit. Everything works sometimes, nothing works all the time. And so when you're building your strategy, you're building it and you're thinking just about those entries, but then you realize that, wow, and it feels like this is the same situation I just had yesterday. And I bought this trade or I sold this trade and I lost. And you're like, okay, I understand losing is a part of it. But really, when I look really at this exact same setup, when you go back, you say, what changed? Why is it not working? And why is it that some days it works and some days it doesn't? And some days you have a trade where you have it on and then you cover it and then, wow, it keeps going. And other days you cover it and then, whoa, it reverted back to the mean right away. And you were like, wow, thank God I got out of it. And then you start digging deeper into the strategy. And one thing that I have really recognized over, I would say, man, I always say over the last 5 to 10 years, but it's even been longer than that now because as time just keeps going by. Since really the introduction of, I would say, high frequency trading and just how more and more algorithms have come into the marketplace, which has been some time now, you get a lot more one-dimensional trades and you get a lot more trend days. And you do that, I think, well, there's a lot of reasons why, but one of the reasons that I think we see a lot of trend days is because you get a lot of traders that try to, fade a move on the short term, right? And those algos see that there's really nothing behind it, or there's something that triggers it, and it just keeps like kind of ticking against you. I remember back when I first started, it didn't seem like we had this many trend days. And it was just like a lot of times we would make a 6 to 8 point range when I first started. And almost every single time during that day, and once we got to an 8 point range, if you just sold that or bought that, that was good for a buck or two in the S&P because our ranges were only 6 to 8, maybe $10 a day, right? And the market didn't move outside of that range. And nowadays, man, you could have a 10-point range, you could have a 100-point range in the S&P. And so as the prices go up, and you get more and more computer trading and you get the percentages of the moves become, the price of the move becomes not as big as a percentage, meaning that, like, let's just say a 1% day now is almost 41 points, right? So versus back then, a 1% move would be 10 points, right? And so the percentage moves, the amount of points in a percentage move is bigger. I knew I'd finally get to that on how that worked. But that to me is why it's so important to recognize and to identify when we have a trend day.
So it's interesting. You're right. I as a technical analyst, I've always looked at the charts in terms of not just absolute value, but also percentages. And what you're really saying here is, through the course of your career, the tick size stays the same for the most part, right? But the range gets increasingly, larger as the market has generally ticked up, right? It doesn't go down. I should say over a long period of time, it's just by nature, stock index futures go up. The range goes up, the prices go up. Whereas, like you said, 1,000 might have been the value of the S&P, where now it's 4,400, 4,200, that area. So yeah, I think that's really important now, that a big move can truly be, multitudes of ticks, whereas before it was a handful of ticks.
Exactly. And the higher that we get priced wise in the S&P, NASDAQ, and Dow is kind of, its own kind of thing, because it's always been priced relatively high to the other indexes. The more points you have within a day, the more points you have within a short-term move. And so this is a time when you have to do your big picture homework to identify if an intraday shorter term move could have some legs. One is because you don't want to fade one of these moves. And I always look at that as the most important aspect of identifying a trend day, is not wanting to fade it. It's not as much as it is capitalizing on it, although that is also very important. But a majority of the time, a trader is going to get caught fading a trend day at some point, and that's when they get hurt. And I've learned in my experience that you really have to eliminate more of the bad days, because that is really the best way to take your P&L up. It's not necessarily making more money at first on the good days. It's about eliminating the bad days. It's about being more efficient on the days that the market is just not probably going to give you what you want. And so identifying what type of day it is, and what I'm going to show you today, everybody, is really helped me tremendously on identifying trend day versus sideways day.
That's interesting, because you hear those stats about, let's say, the S&P 500. 1 year it might go up, let's say 15%, but that 15% was a handful of days where it went up, right? What you're saying is kind of the opposite. We don't really care about those days. We want to minimize the days that are not in our regimen, that don't give us the good trading setups.
Yeah, I like coming into the day, green light long, green light short. Is it yellow light? Is it red light short, red light long? Because I just feel that, and I've said this so many times, and it's going to sound, repetitive, redundant to some people, but the best executors are the ones who make the most money. It's not the best strategies. And so ultimately, I just feel like context matters so much. This is develop your edge. And by developing your edge, and why we do this show, is put yourself in the best position coming into the day, coming into the week, right? This is an ongoing process. The market's constantly changing. And I've said this a lot lately as well. Look at how different this year is than last year. It can't be more different. January, February, and March of last year, a completely different type of market than we have this year. This year, pretty much the lows are on the open, right? You have a totally different market in crude oil. You've got a totally different market in gold. You've got different markets in rates. I mean, look what happened in the 2-year and the 10-year in rates. I mean, there's so many things that have changed. So if you don't put yourself into what today's markets are, and just give yourself the simple thought, whether you're the newest trader in the world, or you're a trader who's been doing this for 25 years or longer, red light, green light, yellow light, it just helps you come into the day and look at, we live with the result. I always say this even on the golf course when I see guys struggling, and I say this to myself as well. Follow the process, live with the result. If you know what you want to do coming into the shot, coming into the day, you've already started that healing process because you're like, look, I at least am committed to this side. And what a lot of people end up doing, as I said, they get so hyper focused on that super short-term entry that the only thing that they're looking at is that entry, and everything around them becomes blurred. And at that point, they've lost sight of what they're trying to do, right? Versus coming in and understanding the context of that day. And so that's what we're going to go over next.
I like that. Follow the process, live with the result should be on the back of your t-shirt, I think.
Yeah, well, look,
That's
I'm printing these now, so I mean, I could do anything with them.
That's right. I love that. Yeah, let's take a look at the chart.
Let's take a look at the
What we're
charts.
doing. Yeah, I love it.
And so, I pulled up the E-mini S&P. I've got the micro NASDAQ and the RTY. These are the markets I trade. I talk about this a lot. And just for a lot of you guys and girls out there that don't know, you've got the options between the micros and the full contracts. I know most of you are like, I know, kidding, Deli. I know that. But I just want to remind all of you, make sure you find the product that fits your size the best. And there's also times where I'm going to talk about that a little bit as well. When you have a neutral day, like I primarily trade the ES. But on days where I'm neutral, I'll go to the micro ES. And maybe you still feel like you're trading the same amount of contract size, you're clicking as much, and some of us need to click. And that's okay. You go in there and you're able to just do it with a smaller amount of risk. Of course, I use the micro NASDAQ almost all the time. I very rarely go to the big NASDAQ because I like to scale in with it. So I just wanted to make that the first thing to discuss. But I'm actually going to go to the Russell first. And, this Russell got me the other day because, it was interesting. I didn't look at this before the open. Shame on me, right? I came into the day and I was looking at, so actually let me go back to the S&P. I looked at the S&P and I looked at the micro NASDAQ. And if you look at them right now, what I have up on these charts is a 10-day simple moving average. And I have an auto anchored order flow VWAP to the first day of the month on a daily chart. Very simple to do. And I really highly recommend doing it. To me, it really helps me represent what trend is. And I took a peek at both of these and I didn't go to the Russell and I said, you know what? Look at the Russell. I didn't look at the Russell and I said, NASDAQ and S&P are in there. And then all of a sudden on my chart, I was looking and the Russell triggered a little long setup for me. So I stepped into the Russell and I took a long setup and I had the trade on. I saw the NASDAQ and the S&P, not trading really as strong as the Russell at the time. And the Russell was staying relatively big. And I'm like, oh, here's a day where maybe the Russell was going to keep going. And then all of a sudden we just had this sharp move down in the Russell. It came out of nowhere and it just was breaking like nobody's business. And I got stopped out. And I said, you know what? I thought today was going to be a trend day up on the Russell. And then I went to the daily chart and I realized it was below the 10-day or just above the 10-day moving average and below the auto anchored VWAP. And so the reason why I'm starting there is because that's the moment of where I make the mistake, and we all do it, where you came in and you didn't have that red light, green light, yellow light situation, right? You could see that the Russell is the weaker of the indexes, as I've just shown you. It's below, it's not below the 10-day, but it's a little below the auto-anchored VWAP, while the NASDAQ and the S&P are above. And so that's the first thing that you look at. And you want to see for any sort of trend day, you want to see that index is above the 10-day. And typically I like the 10-day above the auto anchored order flow VWAP. So in this particular case, you have a 10-day moving average, which is red here. And then this brighter, thicker red line is the order flow VWAP, which turns green versus red if you are above it or below it. So I like to look at colors and they help me with red light, green light, yellow light, right? And so now you have a situation where the Russell on the daily chart is by far the weaker market. Okay, it's pretty much where it opened the year versus S&P and NASDAQ. And then you have it below the order flow VWAP, and you really have, I don't really look too much at the pitch of the 10-day moving average. It's relatively flat, but overall it's going to tell me what? Most likely bearish, but possibly sideways, right? So that's the first thing we look at. And then we go and we look at the micro NASDAQ, and you could see higher highs above the 10-day moving average and above the order flow VWAP, which is green. So now you have checkbox 1, checkbox 2, and really checkbox 3, which is making higher highs is the market trending up, right? Because we're identifying trend days. And it's really one of those things where it's as simple as, are we in the belly of the beast, right? Are we in the belly of that market profile, volume profile a lot of people look at? Or are we on the tips? Are we on the edges, right? A lot of traders that look at volume profile or market profile will say the edge is on the edges, right? Where you want to be long into the edges, and then those where the highs are going to be made and eventually revert back in, but you don't know how far those edges are going to be drawn, right? Especially in the NASDAQ. So you have above the 10-day moving average, you above the order flow VWAP. And then you go to the E-mini S&P and you see not the same as the NASDAQ and not the same as the Russell. You see something that's also different, but you do see it above the 10-day and you do see it above the order flow VWAP. Now, think about this in the context of the situation. And I'm going to ask the audience, maybe you guys put this in chat. If you got a long setup on the NASDAQ, the S&P, or the Russell today, which one has the highest probability of being a trend day to the upside? Let us know in chat. I'd love to see what you guys think. And it's a simple question, but it's just looking at simple tools. What do you guys think? And I'm starting to see some people even message me. And the answer is NASDAQ, right? And the reason it's the NASDAQ is because why? The NASDAQ, when you look at the indices, this is the one you want to be long. This is the highest probability for a trend day up because it is above everything. And see, so many people will look at this and potentially say, and the reason why I'm bringing up all three indexes, I'm going to come full circle to this, is because when you have the strongest market, that's the market you want to be long, right? You want to be long the strongest market. You don't want to be long the weakest market like the Russell and say, oh, well, today's the day it's going to catch up. There's a reason it's the weakest, right? People don't think about this. They think, well, let me come in and buy the weaker one. Maybe it'll play catch up. I go back to the mistake I made the other day. I tried holding on to a Russell long and it came back and stopped me out. And it was because really the one I should have been buying if I had a long setup was the NASDAQ. So the first thing you do is you identify where we are within the indices. And maybe I pause there for a second time and bring you in and just talk about that first step of looking at that.
Right. I agree. And Jim and I talk about this is the stock index futures can be different. They trade differently. We can look at the charts and see that, right? I mean, looking at even the daily chart, you can see that Russell is nowhere near its highs from February, whereas on the NASDAQ, we're exceeding that. So right there, you've got a preference of one is performing stronger than the other. And then you drill down into the indicators, like you said, compared to the anchored VWAP, compared to the moving average. And this is what we do as technicians to some extent to say, hey, where are we on the trend on the longer term? Are we above? Are we below? Are we going to expect resistance? Or are we past that and we're extending like we are on the NASDAQ? So it does make sense. The idea of something has more room because it's more beaten down doesn't work here when you go from a really long term to a shorter term.
100% right. And the next thing I want to talk about when you have the three indexes up, when the indexes are working together, you get the biggest moves. When you have divergence, like I just showed you, when you have a NASDAQ that's really strong, an S&P that's kind of in the middle, and the Russell that's on the weaker end, and you could throw the Dow in here as well, I just don't trade it, you are going to have sideways to choppy markets. Your probability of really strong trend days in any of these markets, this goes as far as the NASDAQ and the S&P right now, based upon that simple thing that I talked about, is very unlikely. And the reason is because you've got a push and pull market. If you go back and look historically, when markets have the biggest moves is when they work together. You never have a massive up here in the NASDAQ or the S&P with the Russell or the Dow lagging. You might have a 10 to 20%, which is still, I guess, relatively a massive year, which you're somewhat having in the NASDAQ. But the opportunity for that move to continue to really have strength to the upside starts to diminish over time as other players in the market look and say, you know what, this is just, we have divergence, right? And divergence is when they don't look the same on the chart. Go back and look and historically, when we're making lows, when we're making highs, when all three on these indices, and we'll say all four because the Dow, they look the same, you have the cleanest moves. Go back to last year. Every chart looked almost the same to the downside. Very, very similar. We're making lows on the same days. We're reverting back in similar days. That tells you a lot. When you have divergence, don't expect a lot. you're reducing targets even on trend days. So that's why I kind of went about this and said, see all three of them and see where we are. So even for me today, I'm actually long the S&P. Yesterday I saw a good close. I'm long some options and I'm long some micros. I went to the micros for this. And I'm like, maybe we've got some potential to the upside. I'm trying to stay really small, and really because I think, there's quarter end and there's month end. Maybe we'll talk about that a little bit as well. But I am looking at it and saying, I think we could go up, but I really have to be small because I'm going to expect it to be choppy, because right now we just don't have a clear path with divergence in the indices. The longs are going to continue to be fought with some resistance, even on trend days, because you have divergence. Now you start to see the Russell break through and you start to see things start to form where they all look similar. That's when you start to look and say, now maybe I could pick and choose which one I want to be in, and then maybe they all go together. And now you go back to the product of choice. But if you're trying to take advantage of a trend day, you always want to be in the stronger one first.
So Anthony, you bring up a good point about when there's no divergence, when they're all in alignment, you get your bigger moves. Is this due more to external factors? Let's say something like we get out of COVID lockdowns, war starts, war ends, something that is generally lifting or depressing the markets universally, as opposed to something where one index during earnings seasons might see a lift because good earnings and some companies that are big might move the index more, or something with the dollar might affect the small caps differently than the large caps versus the techs because of how their general economics works. Is that kind of what's in play here, or do we even care as traders?
I would go as far as saying if you're an index trader, you have an idea of that macro landscape and understand it. But at the same token, the chart is going to tell you that information almost without you knowing it, right? Because I don't need to be a macro expert to know that they don't like the small caps versus the tech right now. Tech right now is leading the charge. You look at Apple, you look at all these other tech companies, you look at Meta, they're all having big years coming back. And so therefore you have a NASDAQ leadership to the upside. And maybe that is directly tied to how weak they were last year, and maybe they're just coming back a little bit, and maybe the Russell's just less in favor right now. I mean, I would say that it's you want to understand it in some context, but the chart is going to tell you that as well. My good buddy Tom Canfield, he's been talking about this forever. Just follow price, and of course, my friend Alpha Trends as well. They are just really they're really going to tell you that just follow price, right? And so I think that when you are looking at these indexes, and that's what most of us trade, right? And this goes the same thing whether you're trading gold or you're trading these other markets as well. Because you have the indices, I like to look at all of them, but you could look at this independently on gold and oil and natural gas. I mean, natural gas, I don't think there's been a positive look on that thing for months. And so when you look at that, all of the trend days are going to be down, and they have been, right? And so I really like to show this on the indexes, because this explains why we are having this type of year, right? This is the type of year where we are very rangy right now. Let's go back to the S&P, which is the big dog. And you look at it, the S&P is always going to be push and pulled depending on what the other indexes are doing. And so right now, you don't see very little follow through on trend days up or on trend days down. You can see that they just stop randomly. Oh, maybe a double bottom type thing. They're just, if you ultimately just look at it, it's just a range bound type market. And so now we have to go to the shorter term to get that conviction of how we execute a trend day. And then we're going to go to the S&P. So for a day like today and day like yesterday, let's take a look at the chart in the S&P. And I go to my 3-minute. Everyone knows I love that 3-minute if you've watched this show before. And what do? I auto anchor a VWAP to the opening 3-minute bar. And then I watch that VWAP to see where we trade relative to the opening 3-minute high and low. And so we draw our horizontal lines and that opening 3-minute high and low, and look at that VWAP just sitting in there, sitting right in the belly of this. And the S&P represents on the short term what we're seeing on the long term, right? And this is where you have to start. You have to take your strategy and come in and say, okay, I follow what Deli was saying on that longer term. Now let's see what it's saying on the shorter term on my strategy. And this is what I use. First thing I do is I do that, and then I look at order flow delta, right? And I look at the order flow and I say, where's this VWAP relative to the 3-minute opening range? And it's right in the middle of it. And as you can see, we pierce the top of the opening range. We pierce the bottom of it. We come back in, we're sitting right in the belly. Is this representing a trend day? The answer is no, right? There's nothing here that tells me we're probably going to be a trend day up. What would tell me we were a trend day up is if this top of this, or if this order flow VWAP would be above the opening range high, and you would see a definite trend on this shorter term chart. So you realize coming into the day, the S&P is in the middle of the daily charts, right? So the first thought is the S&P is most likely going to be a sideways choppy range. But if we do get a trend up day, I can take that trade to potentially be long, but the ceiling is probably going to be somewhat capped because of the divergence in the Russell and because of the divergence with the NASDAQ. NASDAQ strong, Russell's weak. Even if they're both up on the day, it's still divergence on the daily. Remember that, right? Because it's not confirming technically. Now we go to the NASDAQ, right? Quick look at the daily chart first. Above the 10-day, holding it. Everything looks strong above the VWAP. Let's go to the micro NASDAQ. Let's pull in this chart. Let's go in and let's take my horizontal lines. Actually, I don't need to do that. Just you hit that F6 button. Boy, I love it. There it is. And now you have, well, look at the order flow VWAP number one is relatively higher than the S&Ps, which we expect, right? And it's spending more time above the opening 3-minute range. If I start to see this VWAP start to get above there, that's telling me that volume weighted average price is expanding outside of the opening 3-minute range. I've got my strength coming from the daily. The order, so now I have multiple confirmations also with my order flow. Order flow is positive today, trend day up, but it's just not formatting. It's just not forming yet. It's just not setting up, but we know what we want to look for. No matter what happens today, I want to take the NASDAQ longs versus the S&P and the Russells because of the way it looks on the chart. And look at the way that the downside was. It was minimal compared to the S&P. And look at the upside was stronger versus the S&P. So once again, red light, green light, yellow light, right? Green light long NASDAQ, any sort of support I find, I want to take that trade. It's got the most possible potential for the upside. Quick look at the Russell. We know weak, right? Relative to the S&P, obviously relative to the NASDAQ. We know if anything, if we saw a setup to the downside today, it could be a trend down day, regardless almost of what S&P is doing. And let's take a look at the Russell, right? Now the Russell will come in and we'll do the same thing. We'll do our 3-minute and we'll say, okay, now look at the Russell. The Russell relative to the opening range, 3-minute range, is below it. It's below the VWAP and it's sitting in the bottom part of its range. Everybody, this is why we have this type of market. Everyone goes, oh, it's so frustrating. Why can't we just go up, or why can't we just go down? Because we have divergence. Put in daily context. The days you're going to get trend up days are the days where the Russell's back above the 10-day, it's back above the order flow VWAP, and we're all working together, and you see that. The days where you have the Russell below the VWAP, it's almost the high of the day today. It's barely above the 10-day moving average. You have consolidation pretty much in the S&P for the year, some strength above order flow VWAP and 10-day moving average, but nothing compared to the NASDAQ. You are going to have push and pull markets. And also when you look at what's interesting today is that the Russell also has a lot of cumulative delta to the buy side, which is just the net buying and selling on the bid and offer. And look at most of them are probably could look potentially to get squeezed here. You don't want to be part of the positive delta in a weaker daily below a 3-minute opening range and order flow VWAP. That is a recipe for disaster because you're in the crowded trade on the wrong direction. And so in a nutshell, I hope I gave you guys that visual of what we're looking at. And I went a little long today, but it's an important topic on identifying trend days.
No, I appreciate it. And certainly really interesting when we talk about divergence and even down to the 3-minute chart where you have one market moving one way and the other moving the other. And it's almost like, where do you go? This is a great guide in helping you find out where that is. Real quick, we do have a question of the week. I do want to get to that, and I know you have some business. Anthony, we do have a question from Platinum Fund Trading. This one's from Instagram, so it's a little bit different. The question is, what is the best time frame for day trading? Minute or tick volume range charts?
Oh,
So,
I mean, this is a question that is based completely on personality. It's based on personality of you as a trader, personality of you, the market that you're trading, because you don't want to use certain charts for certain markets, right? I am not a huge fan of tick charts for NASDAQ. I really like tick charts possibly for the S&P. I like more time for NASDAQ because it goes through price so quickly. And once again, NASDAQ compared to S&P, because I think it's a simple way to look at things. NASDAQ's very volatile. So therefore, do I maybe want to go with a little bit more time? So I'm not super focused on these little blip moves. It stays within that bar or that candle or that point and figure or whatever for a little bit longer period of time. So you don't want to get shaken out as much. Price matters much more in the S&P and maybe even the 10-year or even something like crude oil, where it's the prices are definitely, I would say, more important than they are in the NASDAQ. NASDAQ fluctuates through prices a lot easier. So you want to give yourself that little bit of cush of maybe time. And so I think that question, once again, it comes down to personality of you as a trader. How active do you want to be? And it goes without saying that the more active that you want to be, then the shorter the time frame. But there is a balance there. You don't want to create something that, if you do want to be active, you don't want to create something to also make you overly active. So you have to find that balance. And, if you want tick charts, if you like the way that they look, then I say you just go with it. I don't think that there is a preference, but it does matter. Personality of you, personality of the market.
great question there. And thanks for that question, Platinum Fund Trading. Remember, you can submit questions using hashtag AskDYE. Make sure you're following us on Twitter. This came from Instagram as well. If you're in the United States, we can send you a little gift for that. But make sure you're following us at NinjaTrader on Twitter for future questions.
Yeah, and the last thing for today, if I could share my screen again real quick, I just want to show everybody this. I think this is pretty cool that CME continues to keep putting out products. And if you look at this, you now have micro E-mini S&P mid cap 400, and you have micro E-mini S&P small cap 600. I'll put those links in the description of my YouTube, and I'll put maybe some more stuff out there on social on this. This is just really giving you a different way to go in and trade the E-mini S&P. Different products, so you have the small cap 600, the small cap 400, and it's not just the E-mini S&P you have to look at. And I think this is just something that I wanted to point out to traders out there that might have some familiarity. That was a big word for me today, Tom. I don't know why I couldn't get it out, but to the small caps within the S&P, and maybe it's something you want to take a look at. I always say, you have to find the markets maybe where they make the most sense to you at the time, and you go in and trade those markets. And CME Group continues to put out some of these good new products that I just want to keep in the forefront, so traders understand and know that are different products out there, not just the S&P and NASDAQ and Russell and Dow that we talk about a lot here.
Right. No, thank you for that. That's great news. Thanks for everybody for coming. Anthony, it's always great to talk to you. Where can people find you?
You can find me at Anthony Crudele on Twitter, and of course, AnthonyCrudele.com. Pretty much everything flows through at Anthony Crudele on Twitter. And thank you, everybody. And hopefully I helped you slow things down and understand and identify the simplicity of understanding a trend day. It's not that complex, but you just got to do a little bit of homework and let the big picture lead you in the short term, and let the short term support the big picture.
Great. Love it. Thank you so much, Anthony. And we will do this again next week. In the meantime, everybody have a great trading day.
See ya.